Hi guys, welcome to Investing with JYK. Today we'll discuss my first investment mistake. It's a pretty bad one too. Just a little history on this company. Used to I started investing on their platform, lending money to random people, and on its IPO, I was allotted 150 shares at $15. So that was here. The thing went to like $26. I did not sell. So I held that all the way through to about here, and then I bought. And then um, and at that point, there was a scandal where like the CEO did some fraudulent shit, and the thing dropped even lower. I think I sold somewhere here, maybe. I don't remember exactly. But yeah, so you can see I didn't lose too much money. It was probably I think no more than $3,000. So it wasn't much, but it was my first massive loss. It was like down something close to 70-80%. Okay, so we'll discuss what this company does, what I did wrong, and hopefully we all learn from my mistake so you don't have to make the same mistake. So LendingClub is a P2P lending company. It basically connects lenders to borrowers. They used to, their their origin was literally a lending club on Facebook, and then that became a company. And it used to be the case that their investors were just retail investors, so people like me. So it's like a real P2P kind of lending. But soon after they went public, they started involving like bank capital and institutional capital, and that basically also changed the game. So initially I was convinced that this is a good model because they don't use their own capital, and then they basically just charge fees. And regardless of how uh, good or bad uh, the borrower was in terms of the repayment, a lending club itself wouldn't take any impairments. So that was true, but that was the only thing I understood about the company. I was extremely lazy. I did not check the balance sheet. I did not check the earnings. I did not read their entire 10K. It was a disaster. Okay, so how do they make money? So they charge essentially two fees. They charge two fees, and they also have they have a new thing where they sell like actual loans. So the way they do it is let's see. Yeah, I'll show you that later. Where's here? So there is an origination fee for personal loans. So essentially, if you borrow some money, they will be, by the time you get the money, it's already 1 to 6% less. In 2017, the average origination fee was 5% plus. Okay, so that's where majority of their income is from. The other part is from actually, you can probably see it somewhere here. Hold on. Investor fees, yeah. So these are charged. So investor fees are typically charged on servicing. So every payment, for every payment, they will charge you 1% of the payment. So if you get $25, $100, they would charge you $1 for collecting that payment. and that is actually not a very high margin business. So you can actually see that their incentive is to underwrite as many loans as possible because that's where the actual earning is. It's a bit like when the banks started underwriting the loans and then selling that actual loan to the asset-backed security market. So they don't actually hold these loans or collect the interest. They're just interested in the origination process. Okay. So the other thing is that so the way it operates is for at least for individual investors like me, so retail investors, there's a marketplace of uh, maybe I'm still logged in. Let's see. You can do invest. So you can browse these loans if you really want. You can filter them different ways, and you can see, some stuff about the loan, like what is a credit score and when their credit history is and how much they owe at the moment. And yeah, so basically people just borrowing new debt to pay off old debt, most of them at least. And so since being a marketplace, obviously there's a network effect, and the more borrower there is, the better the better, and the more investors there are, the better. But I think for this particular kind of investment, I mean, marketplace, there is a threshold above which it doesn't really make any difference. So if you think about Uber and Lyft, yeah, Lyft is much smaller than Uber, but in major cities, Lyft isn't any worse than Uber. For me, I will just check both apps for the price and pick whoever gives me the cheaper price. So same goes on here. After a threshold, LendingClub, Prosper, or Upstart, these are basically the same. I just go for whichever one gives me a higher return as an investor, and as a lender, I'm sorry, as a borrower, you just go for whichever one is cheaper in terms of APR. And obviously, you also want to be qualified for the loan, so whichever one has looser credit standard, arguably. So looking at their so if you look at their numbers, you can see that the transaction fees, which are basically origination fees, is pretty high and much higher than the maintenance fees, which makes sense because that's 5%. That is 1% of the payment, and the payment is typically spread out between 3 and 6 years. Right? So that's the majority of the income. And there has been a change in terms of the business model. Remember, the one thing I thought that was good about them is that they don't bear any credit risk. They just charge fees regardless of whether borrowers go default, they are not on the hook. But that has changed starting 2016. They started to have significant net interest income. Right, so that's from here you can see there's about one, so that is $10 million, and then here it's gone to like 40 million dollars in net interest income. So if you have a net interest income, that means you are bearing credit risk. Now, why does it show up like this? The way they lend I mean, the way the whole thing works is that LendingClub gives essentially LendingClub is selling you a note. The note is backed by the borrower's loan. So the borrower sells a loan to a bank. The bank sells a loan to LendingClub. LendingClub then breaks it up and sells these notes to individual investors. Each are as low as $25. And when a borrower pays on his loan, LendingClub get paid. So that goes into the interest income line. And that immediately means LendingClub has to pay out to the investors. So that should go into the interest expense line. So in this case, these two items should be approximately equal, except on the edges, because there might be a few days of delay between when interest income has been it comes in and when interest gets paid out. So for a sizable gain in terms of interest, net interest income, almost like 10% of their transaction fees, they're starting to bear a sizable credit risk. And so that's when I think the whole business model is starting to break down a little bit. Okay. And also, oh yeah, the one interesting tidbit is that I invested about $5,500 in 2013-ish. So before they went IPO, that's why I got the IPO allotment. The cumulative return is fairly bad. If I had invested in anything else, if I picked a stock or even bought S&P 500, should have done slightly better. It's 4%. I mean, it's arguably uncorrelated with S&P 500, but in a downturn, in a credit contraction, I'm thinking this number should become worse as well, because people will have no jobs and they will stop paying on their debts. Okay, so that's the story of this company. Oh yeah, one more thing, we should also look at their balance sheet. Right, so let's go to the consolidated balance sheet. Consolidated balance sheets. It's probably here, no? Page 87. Let's go to page 87. All right, somewhere here. All right, here we go. So what do they have as asset? They have some cash, some restricted cash, and you can see the restricted cash. Also, I haven't looked into exactly what they are. They have some security held for sale, so these are just loans. And loans held for investment. So that is something I don't particularly like. They are holding loans and collecting interest. Don't particularly like that. And they have some property that you can't really sell anything. They have some stupid computers, essentially. So the majority of their asset is really just loans held for investment at fair value. And in terms of liabilities, mostly is in here, the notes, certificates. Sorry, this is the part when they're investing or their own cash. This is the part where um, is held actually by investors, retail, like by the third-party investors. So you can see this one here basically is equal to this line here. So they kind of just offset each other. And they also have some debt, a little bit of debt, not too much. And then this is something that I don't quite understand, payable to securitization note. I'm not fully sure what this is, but I did see there's some interest expense related to this particular line item. So overall, the balance sheet is reasonably clean, except this one here, which at this point is lower than their cash. So I'm not, it does not present a liquidity risk from my point of view. They lose money, but last year, so if you look at their income statement, last year their transaction fees grew much slower compared to 2015, and you can see their sales and marketing also grew much slower compared to the previous year. So that seems to be very positively correlated. Their transaction fee, half of that basically goes to sales and marketing, right? And their origination and servicing cost essentially is equal to the investor fees. Even though origination really should go to like this line, this one here really contributes just to the transaction fees, but whatever they want to do. Then they have some gains and losses on the sale. So those are the whole block sales to banks. So instead of selling them notes that actually is that LendingClub is liable for, and then backed by the borrower, the borrower's loan, they're directly selling these loans to some big investors, and they're just buying these wholesale. And I wouldn't worry too much about the losses here, because the way they make money is really on this transaction fee. And you can see that engineering's increased that by a little bit, and other administrative actually decreased a bit. And here is the interesting thing: they got this 77 million lawsuit settlement. I think has something to do with the CEO messing up stuff in 2014 or 15 when he did some fraudulent stuff. And this accounts for half of the loss in 2017. So if without this one, the loss would have been halved, right? So this is not a regularly recurring item. So I think we should cut the company a little slack. 2016, they lost most amount of money. 2017, they cut the loss by half, but they're still losing money. And if you look at, oh, by the way, they kept on they keep on issuing shares. So this is, yeah, you have to watch out for that. They keep on issuing shares. So this is looking at what I'm just gonna go 409 divided by 388. Yeah, 5% dilution in a year. And in terms of cash flow, where's my cash flow? Their cash flow, they do have some cash from operating activities in the previous years. In this year, they didn't. I think mostly was because of this guy. So the difference between purchase of loans held for sale and purchases proceeds from sales of whole loans. The difference in here is $900 million. So that's where that's gone. And in terms of investing, it's all very confusing here, because for them, arguably some of the stuff that are for investing purposes correspond, when they buy some loans, yeah, it's for investing purposes, but at the same time they would sell it out to investors, retail investors. So and this is more close to a bank than normal companies where you can split very cleanly between operating activities and investing activities. But overall, you can see that they're add these two up, you're looking at something that's positive. That was like 400 million, 300 million dollars. And then you got the financing. This is even more complex. I typically stop reading at this stage, but maybe I shouldn't have. But overall, their cash flow, entire cash flow was negative, as you can see the change in cash and cash equivalents. But these two seems to be their main operating activities. So part of the investing activities is actually tied to their operating activities. So I wouldn't say the company's in any kind of cash crunch. They still have undrawn credit lines. They got two. So I'm not too worried about that. And then one more thing, I have a friend that works in LendingClub. She's I don't remember exactly what she works on, but she basically says they use Excel a lot for things that she has imagined that should have been automated, easily automatable things that are still doing by hand. So it's not a well-run company by any means, judging by that. They've been in business for a very long time. It's not like 2 years. They've been public since 2013 or something, 12 or 13, and they've been operating since 2009. So yeah. Okay, so the mistakes I've made. First of all, I did not recognize IPO hypes. So that's something that I've learned very dearly. So every time an IPO comes out now, the first thing I think about is really, is it overvalued? Because that is really the peak of overvaluation. Because think about what companies do just before IPO. They go on roadshows. They try to stir up hype about their company. So that is really the peak, usually the peak of overvaluation. You can see that in LendingClub. Obviously, there's Snapchat, for example. All these companies, when they go IPO, typically it's the peak of overvaluation. The other thing I didn't look at is I did not do a projection on LendingClub's earnings. So I had the rough idea of believing in their business model, but that was clearly not nearly enough. And the third thing is I did not look at any of the metrics in terms of like price to book or EV to EBITDA. All these would have been would show negative, but again, not looking at them and just blindly trusting my intuition, that was a very bad move. And yeah, so these were the mistakes I made. I'm thinking maybe I potentially should short this depending on how their quarterly numbers look. But I lost about 70–80% on this one, and hopefully no one else has to go through the same thing as I did. And be very careful with IPOs, and always read the 10Ks, look at the numbers. Don't just trust your intuition. Um, it's quite dangerous thing to do. Right. If you like this video, please let me know. I have some other mistakes that I can share, and maybe people like mistakes. As Charlie Munger said he wants to do things by inversion. Avoid the mistakes other people made, and you're so much closer to success. Right. See you next time.